This presentation is for information purposes only and doesn't constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of an investment or to engage in any of the transaction. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading foreign exchange, futures, cryptos, and equity markets can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. In Level 3 Expert, we are studying Section 11, one of the most important, game-changing, reward risk winning percentage. This is Lecture 2. In the last lecture, you learned about the concept of thinking in terms of ROI. We examined the concept of risk per trade based off a percentage of the capital in the account. We then moved on to all important concept of adjusting your position size so as to risk the same amount of capital for each trade. The concepts presented in this lecture are very important for a trader to understand. Without a thorough understanding of the concept of trade expectancy, a trader has greatly reduced their chances of success. So now let's discuss trade expectancy. Equals average profit into probability of winning trade minus average loss into probability of losing trade. In other words, trade expectancy is the average amount per trade that the trader can expect his method to produce over the long term. Let's continue moving forward with this concept by breaking down the components. As just discussed, trade expectancy equals average profit into probability of winning minus average loss in probability of losing. Probability of winning and losing are quite simply the win-loss ratio of your system or methodology. Average profit can be calculated by taking the profit generated from a large sample set of trades and calculating the average profit. Average loss can also be calculated in a similar way. Risk. Before we continue down the path of trade expectancy, let's take a closer look at the concept of risk. We have already examined how your risk per trade needs to be based on a percentage of capital in the previous lecture when we discussed ROI. This keeps the risk amount in proportion to the account size, percentage-based return on investment. We examined that concept in the last lecture and saw that as the account suffered losses, the dollar risk per trade decreased, and as the account grew in the size, the dollar risk increased per trade. Means when you are losing less, when you are making, it's compounding and you are making more. Everyone is different. They have different account sizes. They might be comfortable, risking a different amount per trade. For example, John might be comfortable risking 1% trade, while Mary might be comfortable at 2% per trade. Because of these differences, both in account size and risk tolerance differ. We need a generic way to refer to the accepted risk when placing a trade. Van Kethrapp introduced the concept of R and R minus R multiples in his book Trade Your Way to Financial Freedom. Probably you can find this book online as well, Trade Your Way to Financial Freedom. So R is equal to the initial risk that was accepted when the trade was initiated. It is based upon where your initial stop is placed. For example, if Mary has a $50,000 account and has 2% risk per trade, then R is equal to 2% of 50,000, which is $1,000. Hope it's clear. If John has a $25,000 account and has 1% risk per trade, then his R is 1% of the equity, which is $250. So when we put on our trade and accept our initial risk, we have accepted 1 hour of risk. By using the concept of defining it in terms of R, we separate the differences between different traders' risk tolerance and account sizes. Both John and Mary have put on a trade and accepted losing 1 hour or 1 unit of risk. Our multiples is simply looking at targets, profits in terms of the initial risk unit. If the initial R is 1% of the trading account and the trade makes 3%, then the profit were 3R. Or if the initial R is 1% and the initial trade target is 2.5% away, then the trade has a profit potential of 2.5 Rs, because we are risking it on the stop losses, and on the other hand we should give flexibility if there can come more profits. So on profit side we have to make it flexible, but in terms of losing, R means R, that's it. If the R is $250 in no single trade, the client should be losing more than $250. That's the key to success. Targets. When a trader enters a trade, they need to have a method of exiting the trade as well. One method is to have a target, or in the case of trading with multiple contracts, multiple targets. Another method of exiting the trade is to have a trailing stop which will remove you from the trade instead of removing the position at a specific target. Most of our trading methodologies have a first target instead of just an initial trading stop methodology. We've already looked at some potential first targets like the end of space, trend line, GAN levels, clusters, or significant levels. One of the benefits of having a first target is the concept of initial reward to risk. Reward to risk can also be calculated through prior trade results based on just a trailing stop methodology. Reward to risk ratio. This is the third important factor of this chapter. The reward to risk ratio can also be referred to as the risk to reward ratio or the profit to loss ratio, whatever you call. Essentially, the ratio just looks at the profit or reward and compares it to the risk or loss. For example, if the reward was 2 points and the risk or initial stop is 1 point, then the reward to risk ratio would be 2 to 1. It means against every $1 of stock, you have $2 profit objective, which is 2 times. In the first target was 3 points away and the initial stop is 1 point away. Then the reward risk ratio would be 3 to 1. Means if you are going to have $100 profit, it means in that particular trade your potential profit is, if you are having $100 loss, profit is 3 times that 300. The ratio is 3 to 1. If the first target is 30 cents away and the initial stop is 15 cents away, then the reward risk ratio is 2 to 1. Some traders instead talk about the risk to reward ratio, which is, in the prior examples would be 1 to 2. It's up to you. Majority basically called risk to reward ratio, but I would prefer to being optimistic, so I prefer to use reward to risk ratio. So whatever you might have, you need to understand the concept and implement it. There are 2 main schools of thoughts surrounding the reward to risk ratio. Some traders set their targets based on a desired reward to risk ratio that they keep constant. For example, the trader wants a 3 to 1 reward to risk ratio. So once they know how far away from the entry their initial stop is placed, they can then calculate their target. Other traders have variable reward risk ratios that are based on a target and stop level. Generally, those traders don't take a trade if their reward risk ratio is not at a specific level or higher. It could be or better. If, for example, you set your portfolio, so first you have to calculate the R. You say, okay, I'm taking 2% risk per trade, and if you have $50,000 account, it means you locked one option that on every trade you are not exposed more than $1,000, which is the 2%. But on the other hand, you say, that's fine, I locked my leakage of loss. But on the profit side, I just want to keep it flexible. So I will go executing a trade only if the reward risk ratio is, for example, 2 to 1. It means against $1,000, if I'm expecting $2,000 or better, only then I would be entering the trade. This is part of my plan. Otherwise, I will skip the trade and wait. And all that will be based upon price action movement, as we have discussed earlier, to be of practical approach. Generally, these traders don't take trade if their reward risk is not at a specific level or higher, so that you can understand. I've given you explanation why again this is very, very important. For example, the trader might have 2 to 1 reward risk ratio. If the target is 4 points away and the stop is 2 points away, then they can take the trade. However, if the target was 4 points away with a 4-point stop, then they would pass the trade, because in this case reward risk ratio is 1. For example, if somebody is trading gold and based upon the charts, he sees like the stop should be 5 points away, which is $500, and his R is $500. But on the other side, charts are showing him, like different studies, that the profit potential in this trade is 7 pips, which is $700, and his reward risk ratio is 2 to 1. So he must have to have $1,000 or more profits. So he'll have to skip the trade. For the strategies you are learning in the International Advisor here, we prefer to go with reward risk ratio of 1 to 1 or better. Since we have a first target that is predetermined, and we also use price action to define the stop level, we know what our reward to risk ratio is before entering the trade. Then we have a couple of other strategies which actually increase the good odds. We can even reduce our reward risk ratio closer to 1 to 1 by moving our stop even further. Then we have some trailing stop methodologies. So if we really make it 1 to 2, later it reduces the number of transactions as well. You will have less opportunities. So to start with, we really suggest to go by 1 to 1, and later on you can preferably make it maximum, say 1.5 to 1 or 2 to 1 as well. We are willing to go to 1 to 1 because this is the ratio of first target. Most of the trades we take have more than one target. We will study further multiple targets trade where we take profit upon hitting the first target, and then on continuation of trade and other studies we put a trailing stop, and we will discuss in the last lecture of this section 11 how we can make use of the trailing stop. So this will increase the ratio automatically. For example, if due to position sizing we determine that we can trade 2 contracts based on our accepted R, if we exit one contract and at 1 R and the second contract at plus 2 R, then the overall reward risk ratio is 1.5. For example, of our R is $500 and we set it 1 to 1 and we entered the trade. It was very good to go, and the profit potential of the first target was $500. So, but we had another second target as well, which was at $1,000, which is 2R. So at $500 profit, we liquidated one contract and put some trailing stop and some other method to protect the open profit position, and we put it the next target, which was also achieved later on at 2,000. So we liquidated one position at 500, other at 2R. So making overall ratio 1.5 instead of 1, although we started from 1. Reward to risk ratios can be less than 1 if a trader's stop is 1 hour away, but the profit target is closer than 1 hour. Then the reward to risk ratio will be less than 1. For example, a trader has a 50-cent profit target in crude with a $1 stop, then the reward to risk ratio would be 0.5 to 1. If they had a 0.10 or 10 cents profit target, which in case of crude is like 10 points, with a $1 stop, it would be 0.1 to 1, because most of the scalpers might have such strategy because they want to have more and more transactions. So they simply reduce this ratio inversely because the profit potential is flexible. But anyway, we will start with 1 to 1 and targeting 1.5 later. Through both backtesting and actual trading results, the trader can calculate their percent of winning and losing trades. We consider a break-even trade a winning trade when calculating the percentage. As you will see when we take another look at the concept of trade expectancy, the percent winning trades needs to tie in an appropriate manner to the reward-risk ratio. Too many traders place too much emphasis on percentage winning trades. They assume that the higher the percent winning trades, the better the methodology. They attempt to make this number as high as possible, even to the point of lowering their targets and increasing their stops to achieve a higher winning percentage. A high percent winners does not guarantee a system. A trading methodology will be successful. There can be losing system with 90% winners. Yes, once you will go for the calculation, you will realize this point, because it has to be compatible with all the aspects as far as the reward risk ratio is concerned, and position size is concerned, and ROI is concerned. A low percent winners does not guarantee a system. A trading methodology is a loser. There are profitable trading methodologies with a 30% winning percentage, and in the next lecture we will tie together the percent winners and the reward risk ratio through the use of the trade expectancy to seek probable trade outcomes and possible success or failure of a system or methodology. Assignment. If you have not done this already, decide on a risk per trade for your present demo account. Make sure it's a level that allows you to place multiple trades per day based on your own risk per day limit. From past trade data, pick a random set of 20 trades, simmer live, and calculate the following: average R multiple, reward risk ratio, percent winning trade, percent losing trade, and if you are new to trading and do not have any past trade data, then try and generate 20 random past trades on different underlying assets based on your portfolio and based on what you've learned in, and perform the same exercises. Do not worry at this time about the validity of the trade setup. This is just an exercise. Summary. In this lecture, we covered a number of important concepts. We learned about the R multiple concept of risk and defining risk in terms of percentage. We looked at the concept of reward risk ratio and how to properly calculate it. Finally, we briefly touched on the concept of win-loss ratio, and that traders focus on only part of the trading equation when only looking at the winning percentage.